Good morning. It's Thursday, September 12th, about 6 a.m. Central Time. You'll be able to catch me live on CNBC at about 2:15, 2:20 Central Time. I'll be on a show called Market Navigator discussing one of the commodities and hopefully one of the precious metals markets and a trade idea surrounding it. Now, overnight, the precious metals are slightly higher after yesterday's rip-roaring action in the U.S. equity markets. We've got December gold futures up $2 at 25.44. December silver up 14 cents at 29.07. Copper's the big standout, up 7 cents at 4.21. That's almost a 2% move higher. Platinum is up $5, trading at 9.61. To give you a critical recap here, early in the morning yesterday, we saw the August CPI data, which year over year and month over month came in line with expectations. However, it was the core CPI that came in much hotter than expected. Core CPI excludes the highly volatile energy and food prices and is oftentimes a better indicator of the direction that inflation is going. It rose to 0.3%, topping analysts' expectations of a 0.2% increase. That puts the Federal Reserve in a very difficult position. Traders had to recalibrate their interest rate cut expectations. The S&P 500 in gold corrected. The U.S. dollar and two-year Treasury yields had rose. That's on the number release. But by the end of the trading session, the probability of the central bank cutting the Fed funds rate by a quarter basis points on September 18th had shifted to 87% from a 66% chance before the release, causing substantial volatility. Why did it cause a substantial volatility? Remember, I've been telling you all along that the Fed only reserves that 50 basis point cut for a rescue and a panic. There is no rescue and there is no panic needed in this market at this particular moment. So all those traders that were excessively short the U.S. equity markets had to shift and say, hey, what if the Fed doesn't even cut it at all? They have to lift those short positions up, and it became a snowball effect of volatility here, triggering stop losses back to the upside. So if you look at the markets here and the way they're positioned, it's really a soft landing. There's no apparent signs of a recession. Inflation is trending towards its 2% target. Growth is declining, but it's not crashing. Jerome Powell already indicated that the time has come for the Fed to adjust the policy, and they're going to be more accommodative at September 18th. Yes, the unemployment rate is at 4.2%, but it's not nowhere near recessionary levels. So that's the reason why things really adjusted yesterday. Now, today we are going to have a few things coming out. The Bureau of Labor Statistics is going to release the PPI data. That's a producer price index for August. Not as volatile as the CPI data. Economists forecast an increase of 1.8% year over year and a 2.4% rise in the PPI. Slightly higher, slightly mixed from the July data. More importantly, I'll be watching the ECB, where they're going to do their monetary policy decision. The ECB is expected to cut its benchmark rate here by about 25 basis points and take it down to 3.5%. They started cutting their interest rates here once their GDP had really flattened out over the summer months. So what I'm going to really be discussing here, I believe, is a trade opportunity in the gold market. Gold is in a bull market. It's one of the best performing commodities over the last year, up 22%. We've got strong central bank purchases. It's a great hedge against geopolitical risk, and the net speculative fund longs are at the highest level since 4 years. That's why I believe, if you guys have been watching me, that we haven't gotten the real breakdown in that gold market. If you look yesterday, what we posted on the Metals Edge, the tactical ranges, that first buy level was spot on. It was 25.29, and then you look at the sell level, which was 25.58. Both those ranges were touched, and that those first levels really work when you have less of a volatile and more of a normalized trading affair. So what we're going to be also looking at here today is, again, on the silver market, because a couple things going on. If you have gold futures, if they start to break through 25.50, you get copper futures. They're up about 2% right now, trading at 421. What does that tell you? That they're really playing a strength and a recovery in China. If you look at the Chinese stock market, hit the lowest level since 2019. I believe that if you start to see gold futures moving higher, you could see silver futures really take a nice push up here today. So I might be getting a little ahead of myself, but the target, I would believe, on the intraday chart would be the 50-day moving average on the silver, which is 29.51. It's going to take a close over 30.02 in order to reverse the trend. That'll take that more into this giant trading range that we've been in. And I think that if we could break out over 30.54, we'll most likely target 32.50. So a couple of the ideas that I'm probably going to discuss on CNBC is going to be, one, After the Fed makes its first cut, you go back since 1980, gold futures have rallied about 6% on average within the first 30 days. That's an average of what happened in the past. The Fed has transitioned from this hiking cycle to now a cutting cycle. So we analyze that data, we backtest it together. Also, remember we do have seasonal weakness in September for precious metals. That's perhaps why we haven't gotten really going and really started to rally back to the upside. Traders remain defensive. Participants are lacking just a bit in those precious metals. However, you get to the end of September, right around September 30th on up to about October 25th, gold futures have rallied about 13 out of the last 15 years. So what we want to do is we want to see a bit of a breakdown in some of these metals so we can pre-position for the seasonal rally and also the expected rally that we see off the Fed's first interest rate cut. You got any questions on futures and options trading? And please tune in to that program on CNBC at about 2:15, 2:20 Central Time. I'd love to hear what your guys' thoughts are on the presentation that I give. And remember that futures and options trading does involve risk of loss, may not be suitable to all investors. Good luck, good trading.